Have you ever felt overwhelmed by the endless choices of ETFs? Constantly tweaking your portfolio in search of the perfect mix? If you're tired of juggling too many funds and seeing mediocre returns, you're not alone. I used to believe that more complexity meant better results, but it often just led to confusion and stalled progress. What if I told you that focusing on just 2 ETFs could actually outperform most complicated portfolios? Today, I'm revealing my experiment with 3 simple 2 ETF strategies: the Growth Accelerator, Income Empire, and David and Goliath, and sharing the real results. Let's see why simplifying your investments might be the smartest move you can make. For many investors, the journey begins with good intentions, wanting to protect their money and maximize returns. But the path often leads to building a portfolio that's far more complicated than it needs to be. You might start with a couple of broad market ETFs. But soon, the temptation to add sector funds, international exposure, or the latest trending ETF creeps in. Before you know it, your portfolio is a patchwork of holdings, and instead of feeling confident, you're left second-guessing every decision. This is the trap of over-diversification. Research shows that many investors end up juggling a dozen or even 15 plus ETFs, convinced that each new addition will fill a gap or boost returns. But what actually happens? Your attention is divided. Your efforts are scattered. And you spend more time worrying about overlap, rebalancing, and whether you're missing out on the next hot sector than you do building real wealth. Instead of clarity, you get confusion. Instead of focus, you get analysis paralysis. Analysis paralysis isn't just a buzzword. It's the real result of constantly tweaking and monitoring a portfolio full of overlapping funds. The more ETFs you add, the more you worry. Is my international exposure enough? Am I too heavy in tech? Should I swap this fund for that one? Every new ETF brings a wave of research, second-guessing, and the nagging feeling that you're never quite getting it right. This constant state of uncertainty doesn't just waste time. It can drag down your returns and make investing feel stressful instead of empowering. Let's look at Sarah, a typical investor who wanted the best out of every world. She started out with a simple setup, just 3 ETFs covering the S&P 500, international stocks, and bonds. But over time, she kept adding emerging markets, small caps, sector plays, commodities, and more. At one point, Sarah's portfolio ballooned to 18 different ETFs. Managing it became a chore. She worried about whether her allocations were off, spent hours rebalancing, and felt overwhelmed by the sheer number of moving parts. Eventually, Sarah decided to simplify. She sold off the excess and focused on just 2 core ETFs. Not only did she see her returns improve, but her stress levels dropped dramatically. With fewer funds to manage, she finally felt in control, and her portfolio's performance actually started to outpace her old complicated setup. This isn't just Sarah's story. It's a pattern that plays out for countless investors. When you spread your money too thin, you lose the power of focused growth. Overlapping holdings mean you're not as diversified as you think. And chasing the latest trend often leads to buying high and selling low. The research is clear. Simplicity doesn't just make investing easier, it makes it more effective. Warren Buffett says the know-nothing investor can outperform professionals with a simple index fund. That's because broad market ETFs offer instant diversification across industries, sectors, and market caps. Instead of trying to outguess the market, you own the whole engine of economic growth. These funds have weathered every kind of market storm from the Great Depression to the 2008 crisis and the COVID-19 pandemic, delivering steady, reliable returns over time. So, can just 2 ETFs really capture the market's full potential? The answer might surprise you. When you choose the right pair, you combine growth and diversification in a way that's both powerful and easy to manage. You spend less time worrying and more time letting your investments work for you. And the psychological benefits are real. Fewer moving parts means less temptation to tinker. Less stress and more confidence in your long-term plan. Imagine what it would feel like to have a portfolio that's not just simple, but purpose-built for growth without all the extra baggage. That's where the growth accelerator strategy comes in. Imagine being able to capture the growth of America's largest and most innovative companies while keeping your portfolio easy to manage. The growth accelerator, Build Wealth with Simplicity, is all about that balance. This strategy uses just 2 ETFs to give you broad exposure and a powerful tilt toward high-growth stocks with the goal of maximizing long-term wealth. The foundation of the growth accelerator is the Vanguard S&P 500 ETF or VO. With VO, you get exposure to all 500 of America's largest companies. These are the giants: Apple, Microsoft, Johnson & Johnson, Berkshire Hathaway. Spanning technology, healthcare, finance, and more. VO is designed to capture the steady, reliable growth of the overall U.S. economy. When the market rises, these companies often lead the way. Over time, the S&P 500 has shown strong, consistent returns, making VO a solid anchor for any portfolio. That's why this ETF makes up 70% of the growth accelerator allocation. It provides stability and broad diversification, helping your portfolio weather the ups and downs of different market cycles. The second piece of the strategy is the Schwab US Large Cap Growth ETF or SCHG. This ETF zeroes in on companies with rapid revenue growth, especially in sectors like technology, communication, healthcare, and consumer discretionary. These are businesses that aren't just large, they're actively reshaping their industries. Think of companies like Tesla and Nvidia, which have changed the landscape of transportation and computing, or innovators in healthcare developing new treatments. SCHG captures these dynamic, fast-moving companies, and that's why it takes up 30% of your portfolio in this strategy. By including SCHG, you're aiming to accelerate your wealth-building potential beyond what the broad market alone can offer. Some investors worry about the overlap between VO and SCHG. In fact, SCHG and VO overlap by about 53% by weight, meaning you're tilting toward high-growth leaders already driving market returns. This isn't a drawback, it's a feature. The overlap means you're intentionally concentrating on companies that have been responsible for much of the market's outperformance in recent years. By pairing the stability of VO with the growth focus of SCHG, you're tanking the odds in favor of capturing both steady gains and the upside from innovative leaders. Let's put this into perspective with a real-world scenario. Imagine Jake, a 27-year-old early in his career, focused on long-term growth. By using the growth accelerator approach, Jake feels confident riding the market's broad growth while capturing big tech's upside despite ups and downs. Over the next 20 or 30 years, this mix could help Jake's investments grow faster than just sticking with VO alone. The journey won't be smooth every year. There will be periods of volatility, especially since SCHG is more concentrated in sectors like tech and consumer discretionary. But for investors with a long-time horizon, history shows that time in the market can smooth out those bumps and deliver strong results. It's important to recognize the trade-offs. The growth accelerator strategy is designed for those who can handle more volatility in exchange for the possibility of higher returns. If you are in your 20s or 30s and your main goal is to build wealth, this approach can give you a strong shot at outpacing the broader market. However, the higher concentration in growth stocks means your portfolio could swing more during market downturns. That's the price for aiming at greater rewards. If you want to tweak the strategy, you can swap VO for a broader ETF like VTI for a total US market exposure. But the core principle remains. Keep it simple. Focus on what works and let compounding do its job. The growth accelerator isn't about chasing every new trend or constantly adjusting your holdings. It's about committing to a straightforward plan that harnesses both the stability of America's biggest companies and the explosive potential of industry leaders. This is a strategy for investors who want to bet on America's innovation engine and are willing to stick through the market's ups and downs for the long haul. But what if your focus isn't just on growing wealth, but also on earning reliable income along the way? There's another approach that combines these two goals. Let's take a look. For investors who want both steady growth and reliable income, the Income Empire strategy offers a straightforward solution. This approach uses two ETFs, 75% in the Vanguard S&P 500 ETF, VO, for broad market growth and 25% in the Schwab U.S. Dividend Equity ETF, SCHD, for consistent dividend income. The goal is to build a portfolio that grows with the market while also generating a stream of cash flow, making it appealing to those who value stability as much as potential upside. Adding a dividend-focused ETF like CHG can significantly change how your portfolio behaves. Dividend-paying companies are usually mature businesses with proven track records, stable cash flows, and established customer bases. They're less likely to swing wildly with market trends and more likely to keep paying shareholders even during tough times. SCHD in particular targets high-quality companies that not only pay dividends but also have a history of increasing them over time. It currently yields nearly 4%, which is a meaningful source of income especially when markets are choppy or flat. What sets the income empire apart is how these two ETFs work together. VO captures the growth of America's leading companies. Think Apple, Microsoft, and other giants, while SCD adds a layer of income and resilience. The overlap between VO and SCD is only 8%. So, you're not just doubling up on the same stocks. Instead, SCHD brings in a different set of businesses like PepsiCo or Home Depot that are known for their steady dividends. This low overlap means you get true diversification and new sources of returns, not just more of the same. Many investors worry that focusing on dividends means missing out on growth. But SCHD's selection process challenges this idea. It avoids chasing risky high-yield stocks and instead sticks with companies that have demonstrated financial strength and the ability to keep growing their payouts. This gives you a blend of income and stability without having to sacrifice long-term appreciation over time. This combination has helped many investors steadily build wealth. In fact, the 7,525 split between VO and SCD has been used by people who have grown their portfolios into seven figures simply by sticking with the plan and reinvesting dividends. As priorities shift with age, some even move toward a 4,060 split, favoring more income and stability as retirement approaches. The flexibility of this strategy lets you adjust as your goals change without having to overhaul your entire investment approach. Another key advantage of the income empire is how it handles market volatility. Dividend-paying companies tend to be less volatile than pure growth stocks because their steady cash flows provide a cushion during downturns. If the market drops, you still receive income, which can help dampen the emotional impact of seeing your portfolio's value fluctuate. You might lag in a tech-fueled rally, but you'll ride out downturns more steadily, which can be especially reassuring when you're relying on your investments for income. For those in their 40s or 50s, this strategy aligns well with the need for both growth and predictability. You're still building wealth, but you also appreciate seeing regular progress as dividends flow in. This approach bridges the gap between accumulating assets and preparing for the next stage of life, giving you confidence that your portfolio is working for you in more ways than one. Ultimately, the income empire isn't about chasing the highest returns or eliminating all risk. It's about striking a balance, participating in market growth while enjoying the psychological and financial benefits of steady income. With just two ETFs, you can create a portfolio that's simple, effective, and adaptable to your changing needs. Of course, not every powerful strategy is based on the obvious choices. Sometimes the real potential lies in parts of the market most people overlook. Let's turn to a strategy that aims to unlock growth by combining two completely different segments of the market. The David and Goliath play. This approach pairs 85% of your portfolio in the Vanguard S&P 500 ETF, VO, with 15% in the Avantis US Small Cap Value ETF, AVUV. The goal is to blend the stability of America's largest companies with a higher growth potential of small cap value stocks, creating a portfolio that's both grounded and geared for long-term upside. VO is the anchor here, tracking the S&P 500 and giving you exposure to 500 of the biggest names in the U.S. economy. Companies like Apple, Johnson & Johnson, and Procter & Gamble. These are the giants that provide steady growth and form the foundation of most diversified portfolios. With 85% of your investment in VO, you're tied directly to the broad market's performance, benefiting from decades of proven returns and the economic engine of leading American businesses. The real twist comes from the 15% allocation to AVUV. This ETF focuses on small-cap value stocks, companies that are not only small in size, but also trading below their intrinsic value, often because they're overlooked or out of favor. These businesses aren't household names, but they have plenty of room to expand. Historically, small-cap value stocks have shown the ability to outperform their larger peers, especially over long periods. Over decades, small-cap value has beaten big caps by about 4% a year. That extra return, when compounded, can make a dramatic difference in your wealth over 30 or 40 years. One of the most important features of this strategy is the complete lack of overlap between VO and AVUV. VO holds the 500 giants. AVUV holds none of them. True diversification with just 2 funds. This means your portfolio isn't just doubling up on the same companies. Instead, you're capturing growth from 2 completely separate corners of the market. While VO keeps you grounded in established leaders, AVUV gives you access to lesser-known companies with a potential for outsized gains. Why does this matter? Large-cap stocks are typically less volatile and provide steady growth, while small-cap value stocks can experience bigger swings both up and down. By combining the two, you're not putting all your eggs in one basket. The large-cap Goliaths help stabilize your returns, while the small-cap Davids offer a shot at faster growth. This kind of targeted diversification can help smooth out some of the bumps along the way, though it doesn't eliminate risk entirely. It's also worth noting that small-cap value stocks tend to shine in certain market environments, especially during recoveries or when investors start looking for undervalued opportunities. While they can lag during periods dominated by tech giants or growth stocks, their long-term track record of outperformance is hard to ignore. Even a modest allocation to AVUV can act as a growth engine, especially if you have a long time horizon. Consider an investor like Emily. She's in her late 20s and looking to build wealth over several decades. Emily's decades-long horizon lets her absorb small-cap swings and harness that extra growth. By keeping the bulk of her portfolio in VO, she enjoys the stability of large-cap stocks. But that 15% slice in AVUV gives her exposure to the kind of companies that could deliver big returns down the road. Of course, this play isn't for fickle nerds, but for long-term investors who can ride the waves. The volatility of small-cap value stocks means you'll see more ups and downs along the way. But if you can stick with the plan, the rewards can be significant. The key is having the patience and discipline to let time work in your favor. With 3 strategies on the table, each with its own strengths, the path forward depends on your goals, risk tolerance, and time horizon. Choosing simplicity is a powerful move in investing. Whether you want aggressive growth, dividend income, or small-cap edge, 2 ETFs can outpace complexity and keep your focus on what matters. By narrowing your portfolio, you avoid distractions and stick with a plan that's built for long-term results. Less really is more. Many successful investors prove it every day. If this helped you pick your path, hit like, subscribe, and let's grow together. Which 2 ETF combo will define your wealth journey? Let me know below. Your next step is to stay consistent, keep learning, and let patience do the heavy lifting.